Okay, folks, welcome back. This is our midweek review for November 13th, 2013. As I mentioned in our previous recordings, we will be migrating to tradingview.com and more or less consolidating everyone because we moved from different demo account companies because of just a myriad of different reasons. Number one, the Forex Ltd that had the dollar index, they, for whatever reason, stopped working. So I'm not sure what the deal is with them, but nonetheless, that was months and months ago. And then we tried Ava Trade, and I was looking at other demo accounts to kind of like give us what we need. And truth be told, I kind of knew we would probably end up here because it's everything. Everything is here. Everything is in one place, and you can access the majority of it for free. And as you can see here, this is the handle I use, obviously. I am ICT. And it's free. So I don't have a GoPro. I don't have any of that stuff. Okay. I may elect to do that later on. We'll see what happens. But it's really inexpensive. But I don't think we'll need to have all of you subscribe to any of that stuff. It's not necessary, I don't believe. But we'll see. I may become a hardline fan of TradingView, and we'll see. The website, once you open it up here, to get to what we're going to be looking for dollar index, you're going to go to the ticker field here and type in DXY. And it may not pop up because it defaults to futures. Click on all. You're going to see two choices here. The top one is what you're going to use, because if you use this one here, it's just going to give you the end of day update. And this one here, the CFD hyphen TVX. You're going to click on that one. All right, and then you're going to click on full featured chart. And zooming out. Okay, there's our dollar index chart. And if we look at the euro, we would use Euro USD on Forex. And then the forex.com, that feed is what we're going to be using whenever we refer to the euro dollar. Okay, that's the euro dollar. And GBP USD, same thing. We're using the forex.com data feed. And that's what we would have as a result. Okay, so if we go over to the dollar index again, DXY, all here. I'm going to zoom in. All right, and this shaded area here is an old weekly SIBI, sell side imbalance, buy side inefficiency. We moved up into the midpoint of that. You can go back and look at all of the August and September reviews. You can see how we were anticipating this midpoint run and minimum, and then anticipating potentially a complete closure of that weekly SIBI. And just for completeness sake, because we are here at TradingView now, there we are right in here, and we were looking for that run up there. Now we are in a trapped formation and price action where I gave you a couple different things to look at. We had this fair value gap. We traded through it. I said if we trade back down into that, that could act as support. That's this right here. You can see price traded through that previous week's Friday, traded down on Monday, came down into almost complete closure of it again, rebalance, and then yesterday we had a nice little run higher, and now we're sitting here. So we're looking for the likelihood of a run up into this imbalance right here. I'll highlight that. So we're looking for this as a potential upside. Now, one of the things that I am considering going forward, because tomorrow we have another Powell testimony, and he's going to be jawboning again. I think 10:30, if that my memory serves me correctly on the calendar. But to check the calendar yourself, you should be doing it anyway. We may get the volatility for the week on tomorrow's discussion. If it doesn't, then obviously we've had a consolidation week, and we'll see what we see on the following week. We have relative equal highs here, and I mentioned this before. We rallied through it, swept, it came lower, tried to rally through it, kept going lower, reaching above, multiple times above these relative equal highs, until we got to the consequent encroachment of that weekly sell side imbalance, buy side inefficiency, again indicated here. And this was the most recent high at the time when I was using TradingView to illustrate this. We poked through that, so that was that red line here is only highlighting this old high when it ran through it. Okay, so half of this range, the shaded pink area, that's that weekly sell side imbalance. Okay, so it went up to consequent encroachment, then gave up the ghost, went lower. Relative equal lows in here, sell side liquidity here, and then we have liquidity resting over here. But before that, we have this fair value gap in the form of a BISI, buy side imbalance, sell side inefficiency. Should we give up these equal lows? In other words, if we can't move above these equal highs in that old high that we clearly had swept multiple times and then went deeper, if we do not have the ability to trade through this tomorrow on his testimony at 10:30, Powell I'm referring to, then we have to watch to see if it wants to erode and go back down into this area. I mentioned this multiple times. In fact, I've mentioned this through the summer and up until recent, where we have been in this really boring range on the dollar. And until we get out of this long-term boring range on the dollar, okay, we're going to have these really just short-lived little runs, and then it goes back to stagnation. Okay, it just sits in the middle of the range. We have the high and the low here. We're sitting right at equilibrium. And again, we have the signature where the old fair value gap, we traded back above it, came down, found support, and it looks like it wants to do a run into this fair value gap. So based on what is in the charts at the moment right now, this is the scenario I would expect to see making a run into this SIBI, okay, sell side imbalance, buy side inefficiency, which is a fair value gap, but defined because it's a down candle. We're looking to be rebalanced. If we fail to rally tomorrow, okay, after Powell's speech and whatever he's going to be talking about, if we start moving lower, your attention goes into here. Okay, now I don't want to add another range in because it's starting to get really busy, but this would be the next area to rebalance. Now, it could come down into this, not tomorrow, I'm saying over the period of several days. It could come down into that, and then we would look for a willingness to repel price higher. It would be the mean threshold of the down close candles of this bullish order block, and it's also a BISI fair value gap. It doesn't have to completely fill that. It's probably 97.65, 97.70. That would be an area to look for a reaction if we sink on or shortly after the Powell testimony during the New York session. I prefer to see it run right into this and make a much more willing run above these equal highs, which is the old high we were looking for. Because if you just look at that green line, and that's hard, but I don't want to have it too strong of a line, but it communicates the context here. It just looks like multiple times it tried to go above that, above that. So if we start to run here, I don't think that this fair value gap is all that would be required to fill. Then it would become an area where we could take profit or look to capture some scaling of a partial on shorts on foreign currency if it can get here, but then holding for ultimate run above these relative equal highs and then completely filling in that weekly BISI. That's what's shaded here, and the top of that range is approximately we'll just call it a full dollar. Okay, so it'll be a 100 level. If we trade down through this BISI fair value gap, this one single candle up, if we trade through that, sell side liquidity resting below the equal lows here, and then it eventually reaching into the fair value gap here, and the sell side liquidity resting below these equal lows. It's up to what their central banks are going to do after Powell speaks tomorrow. Okay, so I'm sure they already have their game plan. I would send it higher on regardless of whatever Powell says. Okay, the thing is, there's a lot of traders and analysts out there that like to decipher. Okay, listen to, okay, he's hawkish, he's dovish, therefore it's going to be this, it's going to be that. And look, like anything else, okay, there's no real science to that. It's gambling. So all we're doing is anticipating a measure of volatility based on him speaking, because him and his words will basically cast a sentiment on the marketplace, and that sentiment is going to be engineered by the repricing at the central bank. So we don't care what he's saying. I don't care what he's going to talk about. I just know that he's going to talk, and therefore that smoke that's coming from him is going to act as a screen of what they're really trying to do. And again, just think of it as a Judas swing. Okay, think of it as a volatility injection. Think of it as a mode of excitement, and we'll see if it wants to do anything based on our levels as outlined here. Because we don't trade the dollar index, we have to use these levels and these ideas in concert with what we would expect to see in the euro and cable. Okay, so when we go to euro dollar next, again, alwaysforex.com. And last weekend, during the weekend review, I gave you guys this area here because Friday we had a nice big down close candle. There you go. All right, so when we have a weekend, okay, so here's the teaching for this midweek review. We had this down close candle here on, what is that, Thursday? And here's Friday, here's Sunday's opening, and then here's Monday's trading, Tuesday's trading, and then Wednesday, today's trading. All right. We had the candle. Let me put it on here so it's a little bit straight. There you go. All right, so we had this low, this candle's low, coming in at 110.36 and 1 pipette. Basically, we're just going to call it 110.36. So 110.36 was the top, okay, or the high of the fair value gap. Now remember, this was Friday's candle. This is all we were left with. So in fact, this is what the price chart looked like. There, okay. And I said, now look at this old low here. Now that it's like that, I got my obsessive compulsive disorder. That is going to be the fair value gap. Now, what am I defining? I'm defining Friday's low up to Thursday's low. So there's the imbalance. This is it, because Friday ended the trading with this daily low at 110.16 and 8 pipettes, and then we were looking for a return back up to this low on Thursday. Should it get there, we could look for a sell scenario and an opportunity to go short, looking for a run below this low over here, and in the order block itself, which is defined by the wick high and the body of this candle here. All right, so that's what we're still looking for, but to keep it short and sweet, we're just looking for a run back down into this old low. If we drop into an hourly chart, Here is that fair value gap in the top. It was what we're focusing on, the top of that shaded area. The range is being defined by this entire shaded area, but I want you to focus just at the top because that was the context. We want to see it trade there and then look for a sell-off. Okay, look for a pattern, if you will. So what patterns existed after trading up into the high end of that fair value gap? What did you see? What do you see right now? And what was available in terms of opportunity? Well, we have a fair value gap here. Price trades up into that. Limit order would have tagged you here near the end of the top end of the fair value gap. And price moved lower. And we create another fair value gap in here. See that? Price came back up, rebalanced that as well. Spiked above this high here. Would that be your stop? It's too close. Well, it's way too close. This is your parent price swing high. Your stop would have to be above that. Price rolls through, runs below relative equal lows. So sell side liquidity is tagged, purged, and it comes back up and rebalances all of this inefficiency. Let me take this off because these crosshairs are not good. I'm learning, folks. Give us time. A couple weeks, we'll be moving a little bit more smoothly with this platform. But the fair value gap here again, that was rebalanced, and then we created another fair value gap with this run lower here, in here. Okay, look at the bodies of these two candles here, here, and here. Yes, we wicked a little bit higher side beyond the fair value gap that was created for this candle. But the SIBI, sell side imbalance, buy side inefficiency, was completely filled in, and the bulk of it is with the bodies of these candles. Then price does what? It runs for the relative equal lows over here, and we run through it. We create another small little fair value gap right in here between this candle's low and this candle's high. Rebalances, goes a little bit above it. It's fine. That's normal delivery. That's absolutely normal. And these are the types of things you need to be studying, because when you see these types of events, if you're executing on a fair value gap as your entry, you won't be swayed, or you should not be swayed by a little bit of adverse price action, because it's going to be a normal event that you're going to have to just weather. And then we had a nice drop lower, running below these equal lows, and then we went into this chop. Okay, and I think really what we're waiting for is that Powell speech tomorrow, and we'll see. We have a little bit of news coming out in London for Euro and cable, but I think ultimately it's going to be Powell's testimony and his speech tomorrow at 10:30 New York time. So if we were to take a step back and look at this, we've had a really flat week so far. Nothing in here looks bullish on the upside. This looks like it's heavy. It just can't find any traction on the upside. So we were looking for a run lower into that 109.90 level. That's the level I'm looking for the order block. If we lose that and start to accelerate through that, we'll be looking for a run below the yearly low. I don't personally see that, but obviously we'll have to see what happens as a result and post Powell speaking. And let's go to the daily again. And cable. All right. Now I mentioned all of this price action in here. This is all balanced, okay? And we like these equal highs over here. Or I do. I've been trying to get you to concentrate here. So right above here we have buy side liquidity. Price has run aggressively. All of this is balanced. Okay, all of this in here is really balanced. And we had a swing low here, relative equal lows. Sell side liquidity resting below these equal lows. That was taken here last week. And then we have since moved a little bit higher. We have buy side liquidity resting above these relative equal highs. If we drop into an hourly chart, okay, let me scrunch this up a little bit. We have a fair value gap in here, also with a bullish order block. Okay, hourly chart, all of these lows, consecutive 1, 2, 3, all down close candles Bullish order block starts at the body. Let's draw that out in time. We'll do that now. Okay, price trades down into that on yesterday, and we get a run above relative equal highs, bearish order block, then consolidation, and then we have relative equal lows with this low left intact. We have a little bit of an imbalance in here that I would have rather seen that trade down into. That could be what they do for tonight. Okay, so what am I suggesting? Watch and see if cable is drawn lower, taking out these relative equal lows, and then clearing this up right in here, and go one more time in this order block, because we only went shallow on this, and they could come a little bit deeper and clear up all of this busy. So what am I saying? Let's look at it like this. See if London does this ahead of the Powell speech tomorrow. Okay, because everybody, good grief, everybody's expecting this bull flag type thing to unfold. Okay, you have this big run up and it's consolidation. All of the stops are resting right below this low and now below these equal lows. To me, if I ran cable, I would absolutely dip it down into that blue shaded area, down into this order block right there. And that would be one more time inside this order block that it trades into to pick up more orders. Then if the dollar is unwilling to go higher, as we were indicating on its daily chart, if it can't go higher, it's going to recede a little bit. So if it recedes, that'll give the green light for cable to make a run above this high here. And then we have the rejection block, which is the highest up close in this candle here, which is 128.82. And then zoom out a little bit. Scrunch this up. We have these relative equal highs back here. Okay, so run below here, that's what I would expect. I would like to see that. If it runs below there and then rejects and goes higher, that's what you could wait for some confirmation. In other words, run below. If you don't want to be buying below into this BISI, because it takes a little bit of guts and you have to buy the sell side liquidity, wait for it to happen and then wait for the run to occur and then look for the imbalance and then wait for a fair value gap to fill in, or use the institutional order flow entry drill, which is buying the top of the bullish fair value gap. And then if it expands, we'll be looking for this over here. I think we're just basically waiting for tomorrow's final discussion by Powell. Okay, and then we'll get whatever volatility was intended for this week on Thursday and then remaining on Friday. So it's been a quiet, slow week with the pop on Thursday into Friday. So that's going to be our weekly profile. If we are to look at, Canadian dollar, dollar CAD, forex.com is the server we want to be pulling data from. And let's go back out to a daily. And zoom in a little bit. All right, so we finally came up in here, filled in this SIBI, sell side imbalance, buy side inefficiency, fair value gap, went right in here, filled that completely. This move, I was not confident with. I said that we could have came down and filled in the imbalance a little bit deeper in here, and I was unsure. Didn't trust it, didn't want to touch it, and this is what you want to have in your charts. Highlight the fair value gap here. Draw attention to these equal highs now, because if we can get above this fair value gap, or if we trade through it and come back down into it, it doesn't have to do that because we're going to be so close to these equal highs. If it can come back down into this fair value gap, and I'll draw it out for you. All right. So if we trade above it, you can see it stops dead in its tracks here. If we trade above it any degree and then come back down into it and find support, we could look for this area to act as real support to allow a run to these equal highs. Now, do we run these equal highs and get up the ghost and go back in the middle of the range here? I don't know. That I don't know. Do we run for these highs back here? Again, I don't know. What we're focusing on and studying is, does it have the ability to trade through the fair value gap and come back down? If it does, then you study on a lower time frame the top of this gap, which is going to be the low of this candle at 132.69, basically 132.70 to 132.65, allowing some in-air price action. So that would be something you can study on a 5 and 15 minute time frame. Should we do that very thing and then look for a run into these equal highs? Looking at every 15-minute time frame, if it creates that return, but it has to trade higher first. If it comes back down in here, focus on a 15-minute time frame, and every BISI, buy side imbalance, sell side inefficiency, fair value gap, use that as a study to get something in to a run above these equal highs. And again, that's assuming, this setup is assuming that we have the dollar make that run into this fair value gap here. All right. So I'm going to be spending tomorrow and Friday getting my charts much more user friendly, so that we guys can see a little bit more details. Just wanted to spend today just kind of going over briefly what has not really happened so much this week, because it's been relatively quiet. Also bring in what markets and how to pull them up using TradingView. And we'll be able to look at other things, and just in passing we'll go through real quick the E-mini S&P, which is the S&P mini futures. Z is the month code for December. H is for March, but it goes to 2020. M is June. U is September, and then back to December. So there's your 4 contract delivery month codes from the beginning of the month. Beginning of the year. The earliest one is March for H, M for June, U for September, Z for December. Okay, but right now the nearby contract for December is the most active, and that's the one you would be focusing and following. So clicking on that, you can see I was asked a couple weeks ago what my expectations were on S&P and what was the likely scenario, and that was down in here. We had a fair value gap in here, trade down to, I said we would see the equal highs, and there's your equal highs, and we've since rallied. I am a little leery of this move in here, and we've had all this run here has been on lower volume. Every time we've gone higher, we're not seeing that increased trend on volume, which is a factor for me when we're looking at futures, because they are real numbers. Okay, there's really no trusted figures for volume when it comes to trading Forex, because it's decentralized. It's not really, you can't get everyone's volume. But if you're looking at a futures market, you're getting every bit of the open interest. That number's real. Okay, it's not fudged. It's not contrived. It's not assumed. it's a real number. So there's certain advantages when we look at futures markets in that respect, because they're very, very transparent. And like I said, you may come into this mentorship and maybe have gone through the mentorship and you're a charter member, and we spend predominantly most of our time on Forex, but you may elect to transition to futures, and there's absolutely nothing wrong with that. I started as a futures trader in the 90s, and obviously my focus is only on Forex. But if Forex ever goes to silliness where it's not something I would trade, it's no problem. We go right back into futures. Okay, and I could be day trading the S&P or day trading the bond market, or short-term trading the bond market. And while we're talking about the bonds, if we're looking at the treasury market, the symbol for that is, and believe me, we'll go through these we'll pass through them once a week. Okay, I'm not going to spend an everyday type thing. I don't want anybody expecting me to be pulling out levels and pointing that on Twitter, because I'm not spoon feeding trades and setups to people that are outside the mentorship, and I'm not doing it for you either, because that builds dependency. Okay, and we're not trying to do that. I'm teaching you independence. I'm pointing, you're shooting. So the bond is ZB, month code Z for December 2019. And there it is, right there. You can see that. All right, so here is that futures contract price chart for the December contract. Whenever you see these little spots over here, okay, I already know what you're going to ask. Why does it look like this? Because it is a futures market. So at this time, the contract that you would have been looking at would have been ZBU for September, because look at the time here, we're in June. June would be expiring. So right about in here, there's a contract rollover where everyone stops trading the June contract and rolls into the September contract. And just for curiosity, let me see if it can pull up the September 2019 chart. Yep, there it is. There you go. So now you can see the difference. Okay, here's that chart, and then we'll go back to the present, and you can see there's that where it picks up. Okay, so all of this just shows there's a lack of liquidity because everyone at this time here was trading the June and rolling into September's contract month for bonds. And all commodities futures markets are like that. They have expiration, whereas Forex, there really isn't an expiration. It's, you know, it's an open 24/7, no, not 24/7, but 24-hour market, and there's really no rollover to a nearby contract. There's a rollover that we pay when we hold the the positions, but they don't expire in the sense that same way that a commodity market would roll over and expire. Like for instance, I can't go in and make a trade on the September contract for the bond market because that contract is not actively traded anymore. It has expired. So if I were to trade the bond market right now, what month would I trade and what month chart would I follow? This one here, December, which is the Z symbol, okay? And I want you to study. This is your homework, and we're going to start having a little bit more of this on Wednesdays and on weekends. I want you to do some homework on this because we're going to start spending more time in the commodity markets too now that we have this medium and we're all looking at the same thing. So all of our charts will have the same annotations, or should have the same annotations and expectations based on the commentary that's provided midweekend on the weekend. But I want you to study this high down into where we're at right now. Okay, it is a low resistance liquidity run, and obviously it's hindsight. I want you to obviously know that we're not trying to pick the next direction in here. I want you to study from this high down into where we are right now. Outline all of the things that you know at the level of your understanding. Do not tweet this to me. Do not send me emails with your charts. I'm going to supply you the notes that you should have, or if you don't understand or know what you'd be doing, then simply just wait. Okay, but I still want you to go down into lower time frames, hourly chart, 15-minute chart, 5-minute chart, and I want you to look at all of this movement in here. Okay, from this high down to here. Okay, and I want you to break it down, screen capture your own charts. Do not tweet them to me. I'm not going to respond to you. I'm not going to say yes or no, that's right. The only response you're going to get for this homework is what I provide to you this coming weekend. I'll outline everything from the daily, from the weekly, the daily, the 1-hour chart, and the 15 and 5-minute charts. Okay, and I'll outline all of this, all the factors that led to this move here, and also what defines it as a low resistance liquidity run. Now, I'm doing this to show you also how you do your journaling. I'm going to give you one more example of this, but we're using it with a commodity, not a foreign exchange pair. And so you can see there's really no difference between how I keep my notes in my own journal, but I'm going to add a lot more in terms of what I generally do for myself, because I know these things. I've been doing it for a long time, but you as a developing student and analyst, you want to be looking at things repetitively that you don't have the experience on. So the way you get the experience is by having a long sample size of different markets, different environments where you classify specific things, and it becomes your most impactful trading book. And it's the book that you wrote with your own words and your own charts and your own annotations. Okay, so there's your homework. You want to be breaking down the ZBZ2019 on TradingView. This is the daily chart. Okay, and I'm not going to drop down to lower time frames because I don't want anything to pop out and you get more insights than you should have by your own study. This weekend, I will provide you all of the breakdown on this move here and some of the insights that you will learn in this mentorship and how it all fleshes out even very nicely in this market. I will tell you this, okay, and everyone that knows me knows this about me. I am more likely to trade the bond market than the stock indices. If I ever leave Forex and I go back to trading commodities, I would only strongly consider trading the bond market because they're absolutely easy. They're easy moves. They are short-term trade and swing trade type moves that if you are a longer-term time horizon trader, this market tends to provide really good setups for that, and it's a good market for that type of trader. Right now, we've been going through a period of consolidation for Forex, and I've got a lot of emails from folks that are they're wore out. Okay, this type of environment has been very hard for them, and to be very blunt, some of them have questioned their ability to hang. And believe me, I'm not laughing at you. I know what it's like. I've gone through that. Okay, but I went through that also with commodities too. But the bond market generally gives us a really good swing and short-term trade setups that are pretty consistent. They're really steady Eddie. There are periods where the bond market can go in consolidation, just like we're seeing with the foreign exchange markets, and you still will have to submit or look to another asset. You might have to find your sugar out of stocks, or you may need to trade a market that you aren't necessarily interested in or any other time, like soybeans or lean hogs. It sounds funny, and these markets trade and you can make money with them, but they still have risk too. So there's always something to be doing. I want you to understand the difficulties in trading in an environment like this in Forex, because you will encounter this and you have to have a plan. That plan doesn't always equate to doing nothing and waiting for Forex. It just means, okay, money's not being utilized in Forex, so where is another opportunity? And that's why you want to have a well-versed understanding about price action, because you can take what you understand in my teachings in Forex to the futures market, the stock market, the metals market. All these other markets do the same things. Okay, there's only certain intraday things that are highly specific to Forex, but nonetheless, it's generally always going to be the same thing, predominantly from a technical standpoint and how price is delivered, because all markets are booked the same way, because all market making is done the same way. All of it's done. And it's all based on the upper tier of central bank influence. So again, whether you're trading stocks, whether you're trading bonds, Forex, whatever, excluding crypto, okay, the central banks are pulling the strings. So if you know they're involved in any capacity, then what's the MO? The things I teach you: imbalance, manipulation, and then rebalance. So all of these things are going to be able to be seen in other markets, and don't let this environment, like we've been forced to study in, because I could have very easily taken you into other markets, okay? But what that's going to do is it's going to teach you that you're always going to find setups and you're absolutely going to have no difficulty. And that is unrealistic. It's unrealistic as a teacher. It's unrealistic as a trader. You're going to have your tail end tore up, okay? You're going to have that happen to you. And you can't avoid it. The only thing you can do is keep it from completely destroying you. But you're going to have periods where you just can't get any traction. You're going to have problems with getting a feel for what the market should be doing. And you're going to feel like doing something, and usually doing something is going to be the worst thing to do. So if you can identify the conditions that we've been outlining in Forex or any market that you're trading, it just means take a step back. Don't force something in that one, okay? Because there's money somewhere else being put to use. And it may be a market or an asset class that you generally aren't actively following, but you can find opportunity in yield, because money is always seeking yield. All right. So in closing, just a reminder, you want to do the weekly, daily, 1 hour, 15-minute, and 5-minute chart on bonds. Do not send me your view on what I'm trying to have you look at this with. Okay, I will give you my spin on the bond market in this move here, using the tools that you're going to learn in the core content and going forward. But I'm doing it just as also a homework to get you into the charts, looking, understanding from your level of membership, because not all of you are going to have the same notes that I'm going to show you. I'm not going to reserve anything. Everything from a charter level, okay, you will see in my notes, because I want you to understand the gravity of these things that you're going to learn. And also, that way you can use it as a kind of like a model in your note taking when you're looking at the bond market. All right, so I will catch up with you guys by way of weekend review. It will be 5 p.m. Saturday upload, so just be aware there won't be anything posting on Friday night. Have yourself a pleasant week. Be careful and try not to force too much. And again, be patient. Don't try to force anything. There's lots to learn in between now and when the markets start moving again. Just for now, keep your powder dry.